Right, funding 101. The starting point is the deposit. Okay, deposit growth is in essence fixed to the rate of growth in the economy. The starting point for us is customer deposits, so we attract them by paying interest on the deposits. Okay, and different types of funding have different costs and different benefits to us. And we've got a separate lecture. This one is from me in module 4 on liability strategy, where we're going to consider different types of funds and what that might mean from the point of view of an optimized funding structure. Okay, so we're going to look at that later in module 4. Beyond the deposit, we might get funding from other banks. Not so much a common thing these days with the capital requirements of Basel III, but that's still there, interbank market. We might get funding from other banks. We might get funding from the capital markets, shorter term, longer term capital markets. We might get funding from structured or secured products, repo, structured finance, covered bonds, residential mortgage-backed securities, so the securitization market. We might get funding from the central bank. What does BAU mean? Business as usual, here down here. The ECB, the European Central Bank, and to an extent the Bank of England, set in place funding schemes that basically provided funding to banks on a business as usual basis. It wasn't emergency liquidity stress funding. It was long-term funding to fund their balance sheets. And that's resulted in the ECB being a primary source of funds for certain banks in the Eurozone. What about deposit pricing? Traditionally, much less, inverted comma, if I can use the expression scientific, traditionally, much less scientific approach to this, but we should also put in place, we should be aware in our pricing committee or our pricing process, what the deposit pricing process would be. Generally, the model or the process I would suggest would be the base rate as the starting point of deposit pricing. We're going to pay at least base rate. This is where I'm paying interest on deposits, by the way. And then also I might take into account the spread, the spread between the overnight interest rate, the reference interest rate. LIBOR is disappearing, so whatever your relevant market reference benchmark is, and the 3-month reference benchmark. There's a spread there, which the longer the tenor of the deposit I should look to pay. I might have my own required funding rate, and which by my own I mean but what my investors need. So I'm funding in the wholesale markets. The investor community will require a rate that I'm obliged to pay, otherwise I'm going to buy my bonds. And then finally, and I would say this is the most important driver, where are my competitors pricing? So deposit pricing is a function of those 4, possibly not in that order. You might say that number 4 is the first and important thing I look at, but those are the usual factors that go into pricing deposits. Supply and demand operates in this field as much as any other, but a bank must also price deposits reflecting that higher rates attract deposits faster, but only up to a point. Consistent highest pricing implies desperation, but not so much now, possibly in the current environment with wherever you've got a country with a deposit guarantee scheme, higher rates simply attract more funds. That's what the second bullet point there is saying, a government deposit compensation scheme. Higher deposit rates drive higher loan rates for NII, thus producing lower quality loan book, possibly or possibly not. But of course, yes, the higher your cost of funding, the higher your cost of lending, and that means you may well be operating in lower credit quality customer franchise areas.